Hi, today we're going to be talking about a next in our series of 90-second finance videos on economic bias. Today discussing the economic bias of a life insurance agent. Let me start by saying life insurance agents are not bad people. Some of them do wear the little jackets with the thing on their elbow pads, and some of them do have a comb over, but most of them are very good dressers and have a full head of hair. But they do have an economic bias. We need to understand it. So we do expect that a life insurance agent has an economic bias or a conflict of interest to sell us a policy. Because if they don't get any commission whatsoever. So anybody who can breathe is a prospect for a life insurance agent. What we don't always understand is how do they actually get paid? That's where the economic bias lies. If they sell $1 million term policy, we might expect that that is a bigger policy than a $250,000 permanent policy, whole life, universal life, or variable life. What you may not know, however, is that the commission on the $250,000 perm policy is actually quite a bit higher than the commission on the $1 million term policy. So oftentimes, the economic bias of a life insurance agent is to sell somebody a policy that doesn't actually have a high enough death benefit for the family, but it does have a higher commission. It's important to understand the economic bias of a life insurance agent, especially because life insurance is so important. But understanding the bias will make you a better consumer of life insurance. Thank you for joining me for 90-Second Finance. Now I invite you to join the conversation on my educational finance blog, timmaurer.com, where personal finance is more personal than it is finance.